Good morning. Market Day Report is on the air. We're so glad you're with us here on a Tuesday. Okay, behind us, little canola going on. How about we start with canola futures? Don't get to do that very often. Seeing a bit of a rally there in the front month, July, but some of the deferreds are moving in lower territory. Well, since we're starting there, let's hit some of the outside, what we consider to be outside markets. We don't see quite as much volume trading on these. The rice market, and we'll talk with Jeremy Zwinger a little later about the rice market, but we are watching July and November in positive territory. Get over to the oat market. It's been up 14% year to date. And we're seeing all of the 2025 contracts in the red. Speaking of red, there's cotton. December at 68.11, trading 24 points lower, still tight range there. Spring wheat, Minneapolis, December contract off 8 1/4 at 642 1/4. Hard red, we call it Kansas City from time to time, 529 1/4. It's down 8 1/4 and just one tick off the day's low. Chicago, the July contract at 535 1/2. It's down 6 1/2. Let's go over to soy oil. Contracts now are higher across the board. Though the July has lost that 48 handle, everything else trading 48 cents or above. Soy meal contracts are higher for July and August. And then the soybean trade is higher across the board. New crop up a couple of pennies at 10.32 3/4, with new crop corn trading penny and a half lower, 436 1/2. However, the July is up too at 435 1/2, 435 3/4. So now we're within a penny of that December contract. Chris Swift is with Swift Trading, and we've really seen that July contract in corn trading to a discount to December. Does that happen very often?
Yeah, we're right in the delivery process there, and we got a little bit of an issue still with the corn crop. We're pretty much all planted out there, and we're looking at the ratings to see how it's growing. But something that caught my attention the other day was November of 26 soybeans. We're already 4.5 million acres shy this year of bean production of the number of acres out there. So anything that takes place this year that doesn't go quite as well, the next year's market is going to become that much more important. We're already seeing about a 30 cent premium, Nov 26 over 25, and it's already starting to make what looks like new highs. It had a new highs, closing high last Friday. It's already on its way up. In the same way with, if you look at the red crop years, the 26, bean oil and bean meal all started to move off of these lows that we're seeing today, and we're not seeing a whole lot of movement today, but just simply because of that factor of so many short acres this year, it's going to, in my opinion, look for the market to kind of bid for acres for next year for beans.
Okay, Chris, if it's kind of quiet in the row crop sector, it's anything but that in the livestock sector. So hang on, we're going to come back and talk about, this is his wheelhouse, by the way. Hang on, Market Day Report continues in a moment. So livestock markets have been on fire. It is National Dairy Month. Class 3 milk, they on fire? Let's see. Oh, not really. We're trading in the red, but still seeing 19s on the August, September, and October, high 18s on both June and July contracts. So we'll keep an eye on Class 3 milk futures throughout the rest of the day. This market has been really hot. 2 consecutive closes higher, and it's up over 26% year to date. Talking hogs. Front month at 102.87, up a dime. 57 higher on the July at 107.77. And really the leader has been that August contract. It's been back up above 110. We trade 109.87. It's off 22. Already hit new highs in the feeder cattle market, 313.32 on the August. We're off of that right now at 312.07. That's 42 cents higher. We're higher across the board. Every contract begins with a 3. And live cattle futures, obviously, every contract starts with a 2. But a 226.80 on the June, that's down 20. Chris Swift, Swift Trading, live cattle June contract expires at the end of this month.
Right.
And we just look at the cash trade. We were up to 235 in the South last week. Convergence.
Absolutely. And now when we look at those other prices going to August, which are 218, significantly lower, we have to say, who is assuming this risk? And it is all the cattle feeder right now. He's having to pay top price for feeder cattle today. If he wants to try to lower that risk, he can buy them out in the future a little bit cheaper, but not by much. He's selling cash cattle today at the absolute highest with projected anywhere from $500 to $600 a head profit. And then when he places cattle today at 313, 314, if we see what it takes to break even and what those futures contracts out in front are pushing, it would suggest about $150 to $200 a head loss. So we're looking at record profits today. We're looking at really bad losses down the road there in just 150 days. That's the difference between what we're looking at being records. So there's a lot of in between that has to be taken up, and whether that's in the cash market or the futures market, either one. But this wide of a basis is very, very negative towards the cattle feeder because he is assuming all the risk with nowhere to lay it off.
I'm going to go out on a limb here, and it's not to say that other sectors don't have difficult decisions to make,
sure.
But if you're cow-calf, it's pretty straightforward there, right? But when you're talking feeders, you're talking about buying, you're talking about selling, and then the feed in the middle.
Absolutely. It's a wholly different ballgame, and what we kind of look at more than anything on there is how much production capacity we have. And if you think over the years, we've never contracted in production capacity. And then from 2020 to 2024, we increased all that considerably with the amount of money that the Biden administration put out there in every kind of form you can imagine. And now we don't have any cattle. So whether those cattle are not there or they are not available to you, one of the two, we're seeing a shrinking amount of inventory for still a large capacity of production.
Yeah, I think one area that, again, we don't give enough time to are those really small packers.
Oh, absolutely.
That are, you know, the harvesters that aren't doing hundreds of head.
Right, and they benefited greatly through all the Biden administration subsidy packages. We have clients that did the same thing. They expanded from 2 head to 4 head, 100% increase. You know, when you think about things like that, it clearly shows how easily that the processor is being impacted, and not much difference in commercial cattle feeding with the farmer feeder. The farmer feeders in North and South Dakota with extremely cheap corn on a horrible basis, that cow's bringing $2.12 a pound, and corn is just not bringing the same amount. So I can feed that corn through that cattle, and as long as I can do it in a profitable margin on there, then it works out better than just trying to sell the corn.
Yeah, I don't know which would be a little more easy to stomach, Vegas or cattle feeding. But I think Vegas with long shot odds is probably easier.
It's about one and the same right now.
Chris, great to see you.
Absolutely, Tony.
Thanks for the update, guys.